Hey everyone, welcome back to Corporate Decoder. Today Glad Capital just filed an 8K announcing a new debt offering, and I am seeing a few things that really stand out. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is raising a significant amount of money, and understanding how they plan to use it is key. Alright, let's dive into what Gladstone Capital Corporation, or GLAD as it is known on the Nasdaq, has just reported. They've announced a new deal where they are selling $60 million worth of notes. Think of these notes like bonds, essentially the company borrowing money from investors. These particular notes are set to mature in 2029, and they come with an annual interest rate of 7%. This is a pretty important move for a company like Gladstone Capital, which operates in the financial services and asset management space. So, what is this $60 million for? The company says they plan to use the money mainly to pay down some of the debt they already owe under their credit facility. This is like refinancing a mortgage to get a better rate or just reducing your overall debt load. They also mention using some of it to find new investment opportunities and for general company stuff. What is interesting is their intention to re-borrow under that same credit facility to make new investments in other companies. This suggests they see good opportunities out there and want to keep that flexibility even after raising this new debt. Let's look a bit closer at these notes themselves. They'll be around for about 7 years, maturing in late 2029. The 7% interest rate means that for every $1,000 you invest, you'll get $70 in interest each year, paid out twice a year. The company also notes that these notes are unsecured, meaning they are not backed by any specific assets of the company. This generally means they carry a bit more risk for investors compared to secured debt. However, they are described as ranking equally with other unsecured debts the company might have, and they are senior to preferred stock. That is important context for how this new debt fits into the company's overall debt structure. Now, about paying back these notes early, the company has the option to redeem or buy back these notes before their maturity date. If they do this before September 2029, they'll pay back the original amount plus an extra fee, often called a make-whole premium. After that date, they can still redeem them, but they would just pay back the principal plus any interest that is due. This gives the company flexibility if interest rates fall significantly or if they simply want to restructure their debt. This new debt agreement also comes with certain rules or covenants that Gladstone Capital has to follow. These are pretty technical, but they essentially relate to how the company manages its assets and investments under regulations like the Investment Company Act of 1940. They also have to provide financial information to the note holders and the trustee managing the notes if they are no longer required to file reports with the Securities and Exchange Commission. This is a standard safeguard to ensure investors get information even if the company's reporting status changes. Looking at the exhibits filed with this report gives us a bit more detail. We see the underwriting agreement itself, which outlines the deal between Gladstone Capital and B. Riley Securities, the underwriter who helped sell these notes. There is also the 7th Supplemental Indenture, which is the legal document detailing the terms of these specific 7% notes and a form of the note itself. These legal documents are where all the nitty-gritty details about the debt are laid out, like the interest payments, maturity dates, and those all-important covenants. One of the most interesting things here is the consistent dividend focus for Gladstone Capital, which has been noted in recent headlines. Companies that are consistently paying dividends often use debt financing like this to either smooth out their cash flow to ensure those dividends can be paid or to fund new growth initiatives that will ideally increase future earnings and therefore dividend capacity. This new debt issuance at a 7% interest rate is a significant cost of capital for the company. With a market cap around $436 million and a P/E ratio of about 10.3, Gladstone Capital is a mid-sized player in its sector. The yield on these new notes at 7% is higher than some of their existing debt, like their 3.75% notes due 2027, suggesting either a higher perceived risk for this new issuance or simply reflecting the current interest rate environment. The company intends to use these proceeds to pay down existing debt and fund new investments. This is a common strategy for business development companies or BDCs like Gladstone Capital. They borrow money invested in other businesses and hopefully generate returns that are higher than their cost of borrowing, with the difference being their profit and capacity for dividends. Based on this filing, Gladstone Capital is actively managing its balance sheet and seeking to expand its investment portfolio. The 7% interest rate on $60 million means they are looking at very significant interest expenses annually on this specific borrowing, potentially around $4.2 million per year. This directly impacts their earnings per S-share and their ability to pay dividends. The company's strategy appears to be focused on growth through new investments, funded partly by debt. The key question for investors will be whether the returns they generate from these new investments will sufficiently outpace the 7% cost of this new debt, along with their other operating expenses. They've also got some preferred stock outstanding, which ranks below these new notes in terms of repayment priority. The risks here are that if the new investments don't perform as expected, or if the economic environment worsens, Gladstone Capital could find itself burdened by this new debt without the corresponding income to support it. This could put pressure on their dividend payouts and their overall financial health. It is a delicate balancing act that many financial firms undertake. What I am watching closely is how these new investments perform. If they can consistently generate returns well above that 7% mark, this debt issuance could be a very smart move. However, if the market turns or their investment picks falter, this significant debt load could become a real drag on the company's performance. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives.